welcome to Market Domination. I'm Julie Hyman. Alexandra Canal in for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The big story here is the PE multiple very high at Walmart. It's 38 times versus the 3-year average of 24 times. So expectations have been very high as the stocks really worked well. And what's really happening is the guidance, and people are responding to the guidance. The guidance is a little softer than street expectations. However, we're encouraged that this is conservative and in line with the past in terms of how Walmart guides. And this was a solid quarter.
Split, no split, it's you never know what happens there. I would just tell you from the record gains or the continued growth in the stock, and obviously it's pulled off a little bit last few days. You don't have to look any further than the results and also where they're investing. And they're investing in significant hardware, software improvements, given all the opportunities within AI. And frankly, they're one of the few companies where we're seeing these investments turn into revenues.
AI is going to help their core business. They're using it for their advertising, for their e-commerce and all that. So I think it's a natural partnership there. So I think that's the key thing. And it's going to help every other company, Facebook and Amazon, to really enhance their product line, their productivity, their effectiveness. So AI is going to help across the board for many companies because of the way it is.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We've got a sell-off going on, pulled lower in part by Walmart and the sort of concerns it's sparking about consumer spending. We've got the Dow off by 519 points or so, more than a percent. The S&P off by 0.5%, and the Nasdaq down by 0.5% as well.
Yeah, Walmart shares are on track for their lowest since November 2023, and that's really been seen as a bellwether, especially when we think about the state of the consumer. There's a lot of concerns right now when we think about inflation, the impact of tariffs. We saw a disappointing retail sales number for the month of January that was ultimately chalked up to seasonality, but still the softer guidance there really spooking investors.
Yeah, and raising concerns about how the consumers are going to be reacting to a lot of the headline noise right now out of Washington regarding tariffs. And speaking of tariffs, Walmart also talking about how it plans to manage through tariffs as it has in the past, but there are still some questions about that. And you can see broadly in retail, we've got declines. Amazon is down, Costco is down, Target down 2% as well. And if we look at the sectors that are on the move today, Walmart in consumer staples, which shows up right here. And then we also have financials that are doing poorly, perhaps because they've been running lately and perhaps in part because of that broader concern about the consumer.
Yeah, Wall Street has been very bullish on financials. There's not quite a clear catalyst for why financials are down today. I mean, year to date, we're still in the green pretty much for all of the sectors except for consumer discretionary year to date. That's the only sector that is in the red here. But financials, we've seen record highs for a lot of those big banks recently, like JPMorgan, Goldman Sachs. Perhaps there's some concern about the economy. Again, policy uncertainties has really been weighing on a lot of these names.
Yeah, I mean, this is one of the best performing groups year to date. So the sell-off coming kind of on the back of that. So sort of put that in context here. Well, stocks are pulling back with the S&P 500 retreating from records as Walmart's dim outlook spooks investors over the earnings picture for stocks. With markets also still assessing the impact of President Trump's planned tariffs and policy shifts, we're taking a look at the investing landscape with Mark Newton, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy. And Mark, in a note yesterday, you were talking, even as the S&P 500 was up there at a record, you said we could see some consolidation here. So it looks like we're seeing that consolidation today. What happens now?
Well, a lot of it depends on your time frame. I mean, in the near term, you could see 3 to 5 days of consolidation. I don't really think we're going to see a whole lot of selling happen right now, specifically because sentiment is actually so guarded and bearish. People have become distracted with a lot of the tariff talk and the potential rise in inflation. And, we see polls like NAAIM, the name survey for institutions, the active institutional managers that has pulled way back in recent months from over 100 down to near 75. AAII is a retail poll, still shows about 11 percentage points more in bears than bulls. So with a market that just hit new all-time highs yesterday, when you look at the S&P and QQQ, I think that's really, really interesting. It's one of the few years where we've come into the year, and yes, it's been a choppy year. However, sentiment has been pretty pessimistic at a time when indices are near all-time highs. So I actually think that's very encouraging for investors.
And Mark, your fund strat partner, Tom Lee, he had a note about how you should never short a quote unquote dull market. So can you explain what makes this current market dull and how that could maybe actually be a good thing for investors?
Well, the market's been largely choppy and almost unchanged for the last 2 months. And so we did see initial all-time highs happen into, November. But despite the S&P and the Qs, and we see equal-weighted S&P, the Dow, the Russell, the Dow Jones Transports, the Nasdaq Composite, none of those are at new all-time highs. So many of those have lagged and are showing divergence. Oftentimes that means that we need to see sort of a catalyst to see this broad-based rally really start to materialize, and I don't think we're quite there yet. However, we have seen a pretty decent downward trend in interest rates on the long end, as well as the US dollar, and both of those are very conducive towards risk assets and thinking that we can push higher. It's almost exactly the opposite of what everybody's saying, that the new administration is going to cause rates to scream higher with the yields above 5%, the dollar is going to go up. Well, all of those things happened last year. Now we're seeing exactly the opposite. And so it might be something just to consider that, there are some things that offset the inflationary impacts of tariffs, meaning higher crude production by 3 million barrels a day, along with OPEC Plus turning on the spigots. That's going to cause crude to likely fall to 50 or below. And I also think that China's weak recovery, we've seen a pretty fragile rebound thus far. The equity market's rebounded, but the real estate market certainly hasn't. So China has a very big potential to export deflation to the rest of the world that would certainly offset a lot of those concerns. And we can't see used car prices and insurance continue to rise at the same levels we have in recent months. And so I take the other side of inflation's going higher. I think yields are on the precipice of a large decline in the next 4 to 6 months, which means, the 10-year can get down, not only down to 4.10, but likely crack that 4% level. And so that's going to be very encouraging for a move back into growth, into technology, and to think that the market can do just fine.
What about all the spending that this administration, perhaps in its next phase is going to be pushing for, whether it's tax cuts or some of its other fiscal measures? Does that mean that, that 10-year at 4%, that its days would be numbered at that kind of level?
Look, spending has been a big problem over the last, arguably, 7, 8 years. And I think that's definitely something we have to come to terms with at some point. There's no easy answer on how to really rein that in. I think we're all hopeful that we can see, progress potentially with what Doge is doing. But honestly, that's a first step. Those aren't things that immediately affect the stock market per se in the short run, but certainly are very legitimate concerns about what's going to happen with spending. Extending the tax cuts, are thought by some to, okay, that's going to be a big increase in money that comes in. However, it's also a very big negative in a lot of ways if we allow that to expire. So, we want GDP to be higher. We want people's taxes in general to be lower so that companies can, hire and it leads to job creation. So there's a lot of, you can choose either side you want, but overall the spending is a big deal with the deficit now at $37 trillion and interest on debt having to be refinanced at rates that are much higher than they were 2 years ago.
So over the long term, you're bullish on tech. You alluded to that move back into growth. But in the short term, especially year to date, we haven't seen tech outperformance as we've been used to, especially when you think about those Magnificent Seven names. NVIDIA earnings are coming up. If NVIDIA is not the top driver within this stock market, at least right now, what sectors and what companies are you looking towards?
Well, I do think the Magnificent Seven has turned from the Mag 7 into the Lag 7, over the last couple of months. However, I don't expect that to last too long. I do suspect that most of these tech stocks are going to start to reignite and push higher. We started to see that with Microsoft just a couple of days ago. Microsoft's been in a range almost for about a full year. And so it hasn't been the stocks like Microsoft which have led. It's really been the Meta platforms, the push into software, at a time when semiconductors have been lagging. So we've seen that move into Palantir, of course. And yes, the last few days, we've seen a lot of stocks start to sell off sharply for reasons that maybe the fundamentals don't justify. And so technically, many of those should be buying opportunities. But when you say what's been working, a lot of it's been the banks, not only here, but also in Europe. It's been the primary driving factor of really why a lot of European indices have managed to outperform US stocks so far this year. It's been a falling euro, and it's been really financials being in a very good spot to a lot of these banks that are outperforming. And so that's happened not only in Europe, but also here, stocks like JPMorgan, Berkshire Hathaway, and the like. So I'm actually very encouraged by the financials. Industrials also have outperformed, and people thought this sector would get hit hard on tariffs, but we've seen stocks like Deere and Caterpillar, some of these machinery names that have a lot of asset revenues coming from overseas. They've actually managed to thrive during this whole time. So I think there's a lot to be happy about, and I think investors really need to ignore a lot of the exogenous events until they start to affect the stock market. And the stock market right now looks like it's operating, with a lot of things that are working that need to be working. That meaning technology coming back, the best performing sector in the last week almost. Financials, industrials, discretionary. We're finally seeing the consumer return to the market after last year, which it was absent. So, I'm optimistic at a time when sentiment is very guarded, to say the least.
I want to ask you specifically about NVIDIA for a minute here, Mark, because we're going to be getting the earnings from the company next Wednesday after the close. We were crunching the numbers here today at Yahoo Finance and found that, NVIDIA accounted alone for 20% of the S&P 500's gain last year. This year, it's only 5% thus far, and it's been underperforming the market. Is NVIDIA still that big, broad market catalyst that it was at one point?
I certainly think so. That when you look at the market capitalization and how much NVIDIA commands of the S&P and also QQQ, and so to your point, it has lagged a bit in recent months. It's been more sideways. Still, stocks like NVIDIA, along with Taiwan Semi and Avago, those are some of the top stocks within the entire semiconductor space. But you only have about 3 of the top 10 outperformers within the S&P that come from the Magnificent Seven. It's been pretty broad-based and spread amongst many different sectors. You have many of the financials. You have Walmart participating and showing great gains. So I do think NVIDIA is important. We heard from the conference calls of the Metas and the Amazons and the Alphabet, how much they all reference NVIDIA in their conference calls, saying that, yes, you're doing lots of capital spending and a lot of money is going into NVIDIA. So there's continuing to be very high demand. I think that it's going to outpace supply. I don't think this company and this stock is going away anytime soon. So I like NVIDIA. I don't care to guess as to what earnings will be, but honestly, the stock has had a very decent rebound in recent weeks at a time when many had given up on it based on DeepSeek, and now it's really started to show much better strength. And for me, as a technician, that's encouraging.
Well, we'll see if indeed earnings prove to be a further catalyst. Mark, good to see you. Thank you.
Likewise. Great seeing you both. Thank you.
We're just getting started here on Market Domination. Coming up, we'll get you caught up on some of today's top trending tickers as shares of cruise liners in particular in focus. Plus, President Trump's ongoing trade wars have thrown a wrench into a variety of industries, including autos. We'll be watching that, potential impacts. And we'll be right back. time for some of today's trending tickers. Let's start with Unity Software. Those shares rocketing higher today. The video game development software company posting surprising fourth quarter results. The company's revenue of $457 million, beating Wall Street estimates of $432.5 million. The stock has dropped about 25% year over year. It also, by the way, announced it's migrating its ad network into the new AI-powered platform Vector. That's in an effort to keep pace with market leader AppLovin. And the company actually came out with forecasts that weren't great. So the stock went down, but then it went up.
Yeah, and that's interesting because you normally don't see that in this beat and raise environment. Typically, investors, they want to see that guidance come in ahead of estimates. That being said, though, we did receive some analyst commentary, Citi writing in a note after their report that it looked pretty solid despite that disappointing forecast. Benchmark also raised its rating on the stock to hold from sell. So it really seems like the turnaround story, the future of this company, that's what these investors and analysts seem to be hanging their hat on. Across Wall Street, we have 15 buys, 14 holds, and now after that benchmark raise, just one sell.
Yeah, exactly.
Not too bad.
So it looks like people are relatively bullish on this one.
All right, well, next up, Bond. James Bond will now be under the creative control of Jeff Bezos. See what I did there, Julie? In a newly announced press release on Thursday, Amazon MGM Studios will assume control of the franchise from the Broccoli family, which have been responsible for producing the Bond films for more than 60 years. Minutes after the news broke, Amazon founder Jeff Bezos took to X to ask fans, who would you pick as the next Bond? Amazon bought MGM in 2022 for $8.25 billion, acquiring the studio's catalog of 4,000 movies and 17,000 plus TV shows. As part of the deal, Amazon gained possession of the rights to distribute all 27 of the Bond films. And that's really key here. They had the distribution rights, but they did not have the creative control. So they weren't able to, determine when the movies could go into production. They weren't able to select the cast. And this is a big turning point because now they can, hence why Jeff Bezos is now asking the public, who should be the next Bond?
What do you think?
Okay, I've been thinking about this.
Wasn't Idris Elba supposed to be Bond at one point?
He was rumored, and then it seemed like he wasn't.
Right.
I love Jonathan Bailey. I mean, I know he's not the obvious choice. He was just in Wicked. He is a little, but then you think of, Tom Holland and Spider-Man did really well. Maybe
yeah,
you
but
could
I feel
take
like Spider-Man makes sense as a shorter guy. I don't know if Bond, although it's not like Daniel Craig is some huge, hugely tall person.
I feel like we need a deviation from Daniel Craig because he did such a good job in that role, and then now that he's done, I wonder what that means for the future of the franchise.
Well, Idris Elba would be,
All right, well, all right, that's Julie's pick. He might still be in the running there. Moving on to some cruise lines. Shares of cruise liners, Royal Caribbean, Carnival Corporation, and Norwegian, all moving lower today after newly confirmed Commerce Secretary Howard Lutnick suggested those companies would have to begin paying U.S. taxes. Lutnick saying in an interview that the ships of cruise line operators fly under the flags of various countries, not the U.S., and therefore they don't pay U.S. taxes. For more on this story, James Hardiman, Citi Leisure and Travel Analyst, joins us now. And James, you said that the likelihood of cruise operators becoming full taxpayers remains, quote, exceedingly low. So is this all just more political noise in your view, and investors, they're maybe overreacting here?
Well, look, yeah, I think that in all likelihood, this is an overreaction today. But I don't want to underestimate what I think the big risk is here, which is just headline risk, right? This is an industry that had been exempt from a lot of the turmoil surrounding tariffs and some of the other policies of President Trump, and now they find themselves right in the crosshairs of the president, which is exactly where you don't want to be. I also think there's a lot of room between where they currently are, which is not paying any federal income taxes, and being a full taxpayer. So it doesn't mean that zero is the right number long term, but I think it's exceedingly unlikely that they would go from zero to being a full taxpayer.
Well, and James, for those of us who are not familiar with the tax structure of these cruise lines, how exactly does it work? Do they pay, depending on, where are they domiciled? Are they paying taxes depending on where the ships are, which flag they're flying under? How does it all work?
Yeah, so let's take a step back. For the purposes of the U.S. tax code, the cruise industry are, they're essentially foreign shipping companies, and they're therefore exempt from federal income taxes. So they're incorporated, right, in other countries, Panama, the Bahamas, Liberia, Switzerland, although they're headquartered in the United States, right? And so I guess if you wanted to tax them, you could either say that companies headquartered here in the United States would need to pay taxes, in which case you would risk them moving their headquarters, right? And there would be significant job losses, particularly in Florida, but also, California, Alaska, even New York. I guess the other way you could do it is that you could say that the time spent in U.S. ports is going to be taxed, and it would need to be taxed at a high rate because at the end of the day, they don't spend a whole lot of time at U.S. ports, right? They spend most of their time either in international waters or at the ports of other countries. So it's not an easy fix here, even if you determine that these are companies that are avoiding the U.S. tax code. But I think the fact of the matter is they were set up a long time ago for this specific purpose, right? So that they wouldn't need to pay U.S. taxes.
Now, this tax exempt status has been challenged in the past. Nothing has happened. So what can you look back on in history to sort of give us a guide about what we could potentially see from this?
Yeah, I mean, look, if history is any indication, this is much ado about nothing, right? This has come up at least a dozen times in the past, and it's difficult to tax the cruise industry without taxing the entire shipping industry, right? Which falls under the same tax code. There would obviously be major issues with that if we're concerned about inflation. What's going to happen if we slap a meaningful tax on all, cargo containers that are coming to the United States? I guess the only pause, right, is that, Donald Trump, the Trump administration, it's a different animal, right? And so these threats are generally to be taken seriously. And again, at a very minimum, I think these cruise companies don't want to be in the news. They don't want to be forced to talk about what is a pretty favorable tax situation.
Right. They want to be in the news for their, big new wonderful ships or whatever it is. And also for their earnings, because by the way, we're looking at this sharp sell-off in these stocks today, but they've pretty much all done very well over the past year and have been outperforming the market by pretty wide margins. So I'm just curious, also taking a step back, whether you think, sort of this aside, these companies have more room for upside.
This aside, I think they definitely have more room for upside. And this included, I actually think this is a buying opportunity, right? One of the things we've always said about the cruise industry is, there's a lot that can go wrong. There's a lot of headline risk, whether it be, fuel prices, geopolitics, any number of issues. But they tend to recover stronger after those major events. And so this could be the makings of, I think, a pretty good buying opportunity. But you're right, the cruise industry is absolutely having a moment. I think what cruise travel represents today is a better product than they've ever brought to the table. And so, I don't think this is just some, post-pandemic trade where they're just playing catch up, because if you remember, they were out of commission for much of the pandemic. I think this is more than that. I think it's a better product, and I think this trade has some legs.
You mentioned some of those potential risks, like higher fuel prices. We've also seen lower bookings in California due to the wildfires, in Canada also due to the strong U.S. dollar. What other risks are you looking at? Because yes, even though we've seen this huge post-pandemic boom, there are still some uncertainties out there. Sure.
I mean, the biggest risks, I think, with the cruise industry is often, as we think about the geopolitical realm, right? Whether it's for a period of time there was terrorism in parts of the world, parts of the Med were sort of taken offline. As we think about the last couple of years, 2 wars happening in the world. Anything that takes significant chunks of the map off the board, right? Capacity is effectively fixed. And so if you take away some of that potential demand, right, you get an imbalance, and you tend to see it in pricing. Having said all of that, the last couple of years have been, far from clean when it comes to those offsetting events. And yet the cruise industry has continued to put up some really impressive numbers.
All right, James Hardiman, thank you so much for your insights. Appreciate it.
Thank you.
Coming up, data from the Conference Board showing some interesting results when it comes to what CEOs think of returning to office. We'll get you the numbers on the other side. Stick around, much more market domination still to come.
Time now for our call of the day. North Coast Research downgrading Axon Enterprise from buy to neutral. The note citing concerns that investors will be let down by next week's earnings report. And by the way, the stock just closed a record. It's more than doubled over the past year. This is the maker of tasers. They also make the body cams. And this downgrade seems to have a lot to do with valuation.
Yeah, lofty valuations. We have earnings next week. Like you said, Julie, always at risk investors could be let down. The analyst also cited some competition that could potentially hinder the company's growth trajectory. And we know that valuation, that's been a big concern, especially within this frothy, concentrated market. So always something to look at. But as you mentioned, the stock is just absolutely ripped. It's up 100% over a 1 year period. Over the past 5 years, up over 500%, trading at a PE ratio very higher than NVIDIA even. So that just goes to put some things in perspective. And, you know, all that being said, on the street, 15 buys, 1 hold at now due to that downgrade and 0 sells. So it seems like there's still some optimism there.
Yeah, we'll see what happens with the earnings.
Yes, definitely. Always something to keep in mind with the earnings. Moving on, CEOs are feeling as confident as they have ever over the last few years. Joining us now for more is Yahoo Finance markets reporter Josh Schaefer. So Josh, the Conference Board out with this data this morning. What did it show us?
Yeah, Allie, so CEO confidence overall hitting a 3-year high, coming above 50 here, shooting up to 60 in the first quarter of 2025. That, again, that's the highest level we've seen in 3 years, and that marks a shift among CEOs that were before cautiously optimistic to now confidently optimistic. They feel better about the overall economic outlook right now and the economic outlook coming in the next 6 months. Pretty good picture if you are, of course, an employee, for your employer to feel good about the economic outlook and not be looking to cut jobs. Does come with a catch, though. If you are a remote employee, you might not like to see this chart. So CEOs saying that they're looking to move more workers into office. So in green here, we have the current worker arrangement. 19% of CEOs said that they have 100% in office. They expect that to move to 26% of CEOs seeing 100% in office. Then also you look at office in 3 to 4 days per week. That's going to move from 67% to 71%. So of course, guys, we know JPMorgan CEO Jamie Dimon recently coming out talking about moving workers back into the office. He feels like it's time to end Zoom. It feels like Mr. Dimon might not be alone here, and the RTO switch and that shift to employees continuing to come back into office feels like something that's here to stay.
Josh, thanks. Appreciate it. Applications for unemployment benefits slightly rising from the previous week's revised level. Jobless claims hovering around pre-COVID levels, indicating solid demand for workers. However, we need to look underneath the surface. For a closer look at the layers of the labor market, we've got ADP Chief Economist Neela Richardson. Neela, it's always fantastic to see you and to get your perspective on these matters because you do have that deep understanding of what's happening under the surface of the labor market. So I'm curious what you're seeing. I know you guys have been doing a lot of survey work. What have you been turning up?
Hi, good to see you, Julie. Well, overall, if you look at ADP payroll data, we're still seeing a very solid market. And even though initial jobless claims can move quickly back and forth from week to week, they're still at 2-year lows. So there's strength there. But underneath the hood, as you mentioned, there is pockets of weakness, manufacturing being one. But what's really interesting is when we turn to our worker sentiment survey, which shows that in the U.S., around 2/3 of U.S. workers feel like they're living paycheck to paycheck. So even though we've seen enormous pay growth over the last 4 years coming out of the pandemic, people are still feeling the pinch of inflation. And that is leading to different ways of providing labor, like getting a second job, for example.
You know, there's a lot we look at when it comes to the labor market, whether we think about the unemployment rate, jobless claims, wage growth. Is there a particular metric that you're focused on when we think about some of these cracks?
Yeah, it's a great question. I think my center of gravity is pay. It's payroll, because that is really where the labor market finds its equilibrium. That is the balance between employers' demand for workers and workers' supply of labor. And you can see how that varies across industries, how it varies across demographics, but importantly, how it connects to inflation. What economists are always the most worried about when it comes to the labor market and inflation is that wages would spiral out of control and trigger inflation. We're not seeing that yet. We haven't seen it, actually. Wages have fallen a lot in terms of growth from the peak pandemic growth rates that they had coming out of it, but they're still elevated. And so in my view, it's why inflation hasn't gone back to more comfortable levels quite yet.
Neela, while we have you, I have to get your take on DOGE and what's happening with government employment, but not even just direct government employment, government contractors as well, right? And, you know, this sort of ripple effect, what's happening in D.C. What should we be looking for in terms of the labor market indicators to see where that's being felt?
I think, Julie, the first place to look would be those initial jobless claims that won't get all the difference in workers who are applying to claims, which is a proxy for layoffs that many economists use in the area. And not just the DC metro area, you know, that federal workers and federal contractors are nationwide. So looking at those claims data is important, as we did today. Also looking in the private sector, seeing if maybe workers are staying put, they're seeing more competition in the labor market, how the private sector responds to what's going on the federal side will be interesting to watch over time. Too early to see that yet, but something I'll be paying attention to.
What about immigration? That's something that I feel like has been maybe a little underreported as tariffs have dominated the conversation. What impact do you think immigration policies could have on the labor side? Is that a concern to you at this point?
Well, if you look at government statistics, the U.S. labor force and employment is supposed to increase at a fraction over the next decade that it did over the previous decade. So like 0.4% annually compared to an annual rate of 1.3% in the previous decade. So employment growth is slowing because a lot of workers are retiring. And so the question is, how do you keep up with consumption and growth? One of those ways is through immigration. Now, it's interesting to me also in this time of hybrid, despite some of the CEO sentiments on hybrid versus remote versus in-office work, one thing that remote and flexible work options do is widen the pool of workers that an industry and a company has access to. And that can be borderless depending on the company. So I think all of this is still in flux. Immigration historically has been really important to sectors like construction, for example. So how the labor market evolves from here will have to take into account the fact that the working age population is aging and we'll need some workers in key industries.
Well, and not only will it affect sort of supply and demand, but it'll, going back to the idea of wages also, couldn't we see some sort of knock-on effects from the immigration picture on wages as well?
Whenever there are shortages, especially like in high demand sectors like construction, like agriculture, you'll see wages adjust. And that's why it is my primary indicator of the labor market, because it reflects this worker supply issue that will be vital to us as the demographics of the country change.
And when you think about the Federal Reserve, we've been talking a lot about inflation and inflation likely to remain elevated over the long term. How much more pressure does that put on the employment picture for the Fed?
Well, right now, the labor market is playing along. It's allowing the Fed to be cautious, to be patient. You saw that the unemployment rate went down to 4%. And so, yes, particular people are always part of the rule outside of what that unemployment rate shows. And there are people who are taking longer to find jobs in this economy. However, the unemployment rate at 4% means that the Fed doesn't have to move quickly, that it can incorporate policy change into its decisions. And I think that's what we're seeing right now.
Neela, good to see you. Thank you so much. Looking forward to more jobs data and more analysis from you. Appreciate it.
Thank you.
Coming up, shares of Palantir sinking today on a report of potential defense budget cut, as well as comments from the company's CEO, Alex Karp. We'll be joined by an analyst on the other side to get you caught up on the latest and what to do with the stock. Stick around, much more market domination still to come.
AI bulls saw a pullback when the world was fully introduced to artificial intelligence upstart DeepSeek, and our next guest believes it may have started a rotation within the sector. For more, let's welcome in Ellen Hazen, FL Putnam Investment Management Chief Market Strategist and Portfolio Manager. So Ellen, let's start there. You believe we're in this rotation away from hardware vendors towards software vendors. What are the implications of that at this stage of the AI trade?
That's a great question, and that's exactly what we're seeing. We've all seen the DeepSeek news that came out a few weeks ago at this point, where it looks as though the cost of using AI is much lower than what we thought just a month or two ago. What does that mean? Well, it means that the companies that are deploying AI are going to be able to build models much more cheaply. They're going to be able to roll this out to their customer base much more cheaply. The whole question about, oh, well, are you ever going to get an ROI on this model? Well, that's an easier question to answer if the cost of building the model is much lower. So just as we saw with the internet rollout back in the late 90s, early 2000s, initially the play was hardware. Remember JDS Uniphase, Cisco, and so forth. But then what happened afterward? It was the companies that were using that as a platform, the companies that built on top of that and offered products directly to other businesses and consumers that ended up being the real winners there. Companies like Facebook, companies like Amazon. And you're going to see the same thing here. So you're going to see the software companies and the hyperscalers accrue more of the AI value than we thought a month or two ago before we realized that the cost of AI was coming down so quickly.
You know, it's interesting because the defenders of some of those hardware companies will say, well, if it's cheaper, that means they could do more volume, right? They can just sell more of the stuff if it's at a lower cost. I'm curious what you think about that take.
I think we all learned in Economics 101 that the demand curve is downward sloping, and the more expensive something is, the lower demand is, and so forth. Or I guess this the other way around. And so therefore, it is true that if something is cheaper, you are going to use more of it, right? No question. The question is, if it is 20% cheaper, are you going to use 20% more, right? If it's half as cheap or half the cost, are you going to use twice as much? And we don't know what that elasticity of demand is going to be. I do think when you have a dramatic price decline, what you're likely to see is definitely an increase in uptake, but more volatility. And so it's not going to be clear for a while whether or not the increased uptake is large enough to offset the fact that it's going to be cheaper per. I don't think it's necessarily a straight line, but I do think that we have proven, think about it, right? With things like memory, the amount of memory on your phone, the CPU power on your phone, the amount of storage for your camera, and so forth. Every time we get cheaper storage or cheaper CPU cycles or cheaper capability, we find a way to use it. So I don't think that's a question. I think it's just a question of timing. How quickly will that happen? And will there be an air pocket in the middle somewhere?
Ellen, is this a rotation that would have happened regardless and DeepSeek just accelerated that timeline? Or did DeepSeek represent this fundamental moment where the narrative just completely changed?
I think that the cost was always going to go down, just as electronics costs have gone down for generations. So that was always going to happen. I think the narrative that changed was really more in the stock market than in the underlying technology. So I think that there were investors who believed that NVIDIA and other stocks like that were going to be able to maintain pricing power and have very high volume growth indefinitely. And that narrative has shifted. But I think for practitioners, for people in the industry, they knew it was going to come down. Did it come down more suddenly? Perhaps, but I don't think it's a fundamental change in the narrative.
So, Ellen, all of this said, are you guys redeploying in this direction that you're talking about, sort of away from hardware and more into software, or are there other areas of the market that you think are even more attractive right now?
We're doing both. We are definitely taking some of the gains off the table in the hardware space and redeploying that into some software names like Salesforce, like ServiceNow, and others. But at the same time, we're also looking beyond the Magnificent Seven to more of the other 493 names. So we're looking at some healthcare companies like Stryker, Artificial Knees and Hips. We're looking at some industrial companies like AECOM, which does power infrastructure, and we're looking at other companies across other areas in financials and across the board outside of just technology.
Are there any trades maybe in the software sector that you should avoid at this point, or maybe take a more wait and see approach, since we've seen how quickly stocks and the market reacts to a lot of these headlines?
I think on the software front, you always need to be careful about not overpaying for growth. Most software stocks that are worth owning are going to be expensive, and so you do need to pay up a little bit for them. But because the multiples are so high, that means that if you see a hiccup in fundamentals, then the stock is more likely to have a dramatic downturn. And so you want to look at a couple things. Number one, you want to look at the free cash flow conversion and make sure that they're turning their earnings into free cash flow. And number two, you want to look at the earnings multiple compared to its own history. And if it's expensive, but it has always traded at that kind of multiple, that's one thing. But for a stock that used to trade at 30 times and now it's at 60 times, I think that's where you might run into trouble. Finally, the last thing we really focus on are earnings revisions. As long as earnings revisions are going up, you might be able to hold a rich multiple. But if earnings revisions start to be negative, then you're going to be in trouble when you have that high starting valuation in the software space.
Ellen, good to see you. Thanks for joining us.
Thanks.
Shares of Palantir are falling today after reports that CEO Alex Karp has a new trading plan that provides for the sale of up to $1.2 billion of shares. In addition to that, of course, we've been hearing some talk of cuts to defense spending. For more on all of this, we're bringing in Louis DePalma, research analyst for industrials at William Blair. Louis, it's good to see you. Obviously,
Great to see you too.
Palantir's sort of a controversial stock, right? People have been complaining sort of about the valuation there. Then you get this report that Pete Hegseth wants the Defense Department to draw up a plan for cuts. What does all of this mean for Palantir?
Yes, first of all, thanks for having me on the show. I've been a big fan of Yahoo Finance since I was in college at Providence College many years ago. But
amazing, thank you.
For your question, what does the Department of Defense budget and Pete Hegseth and Doge mean for Palantir? It relates to how approximately 55% of Palantir's revenue is derived from government customers, and the majority of that government revenue comes from the U.S. government. There are also international government customers, but then within the U.S. government revenue, the vast majority comes from the U.S. Army specifically. Now, with Trump 2.0 and the new regime, generally speaking, there's a perception amongst investors, and some of this has been voiced by the new administration, that there's going to be a shift towards the U.S. Navy and the Air Force. And while Palantir does do work for those customers, it's a much lower percentage of their total government base. And so there are questions about whether some of Palantir's initiatives, new initiatives with the Army, may proceed, at the current pace. For instance, one of Palantir's big contracts is called Project Titan, in which they are providing trucks that are equipped with an array of sensors for the purposes of targeting. And this program is expected to cost between $1 billion and $1.5 billion over a 5-year period. And so there are questions such that, in the new Trump regime, is this program going to start on time? And is there going to be adequate funding, if there are shifting priorities towards, the Air Force, the Navy, the Marine Corps, et cetera? So there are many moving parts here. As you said, it's a controversial stock.
And Louis, we've been hearing a lot of quote unquote noise from this administration. Even if you think about something like tariffs, the only duties that have been implemented is that 10% levy on China. Everything else is sort of up in the air at this point. So do you think this could be just more noise?
Yeah, so last night, several media outlets reported that the new administration is looking for 8% budget cuts. But other media publications indicated that there aren't going to be budget cuts. There's just going to be a shifting in priorities. And so $50 billion that may have gone to one bucket of programs will be shifted towards drones, missile defense, such as the Iron Dome initiative, counter drones, cybersecurity, the Virginia class program with General Dynamics Electric Boat was highlighted, the Collaborative Combative Aircraft program that was highlighted. And so, that could favor, vendors such as Kratos, Anduril, and a bunch of others. So there's just expected to be, a shifting of priorities. Last week, Secretary of Defense Hegseth indicated that the Trump administration wants to outspend the Biden administration in terms of defense. And there were members of the Senate Armed Services Committee that wants to actually increase the defense budget by over $100 billion. And so there seems to be, strong support to continue increasing the defense budget.
Right.
But, headlines right now are driving a lot of the market moves.
Well, so Louis, all of this said, you haven't underperformed on Palantir specifically, right? But it doesn't sound like you're bearish on the defense spending piece of it. Is it a valuation call, or why do you think people shouldn't come in here and buy Palantir?
Yes, I would point to how from the time period of 2021 through December of 2023, Palantir shares went down by 82%. And during that time period, Palantir's government revenue, it grew at 77% in 2020, and then it decelerated all the way until it hit, a bottom at 10%. And, we feel that Palantir's, revenue growth on both the commercial side and the defense side, may repeat its history and, decelerate from these current elevated levels. And, when or if that deceleration happens, the valuation support for Palantir, could be, 60 or 70% lower than where it is today. And so, we would prefer, other names over Palantir.
Gotcha.
Louis, thank you so much for your insights. Appreciate it.
Yes, thanks for having me on.
Well, while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all of the action following the closing bell. Stay tuned for Market Domination Overtime. That's next.
That's the closing bell on Wall Street, and now it is market domination overtime. Jared Blickery going to be along in a moment to get you up to speed on the action from today's session. But I'm going to start with where the major averages ended the day in the red, although up a little bit off of the lows. Really, we saw a big part of it was the Walmart effect, right? And Walmart's outlook for the year, raising concerns about the state of the consumer. I mean, Walmart's also one of the best performing stocks this year, so pull back on the back of that. Similar situation with some of the other underperformers that we saw today, like the financials. All of that said, the Dow finishing down by 1%, about 450 points. The S&P 500 off by 0.4%. It too up a little bit off of the lows, and the Nasdaq down about 0.5% as well in today's session. Now let's send it on over to Jared for a closer look.
Thank you, Julie. With the low volatility and all these record highs just coming in very small increments, it seems like 4 or 5 steps forward, one giant step back. But even saying that, S&P 500 only down about 0.5%, not even there right now, so not a huge loss for the day. Seeing volatility pick up just a little bit here. We can see the VIX is at 15.5, nothing to write home about. And we can also check in on the US dollar index, which critically was trending down for most of the day. And on a year-to-date basis, you can see it is hitting new lows for 2025. Generally good for risk markets, but not necessarily on a day-to-day basis. And let's get into the sector action. Energy is leading today, followed by real estate, healthcare, and utilities. Utilities barely in the green. Those were the only green sectors. Financials in the red for about 1.5%. Consumer discretionary also down about 0.9%. Industrials off. And I was just looking at this a few minutes ago. Look at this. Energy is the best performing sector of 2025. Followed by communication services, healthcare, and then materials and financials. I would guess that most people didn't expect that coming into the year. But we're going to get back to the day's price action. Check out the Nasdaq 100. You see a bit more red than green. And in the mega caps, you got the 3 large ones there that kind of distorts things. None of them up particularly a large amount. But I wanted to head into the Dow. We'll take a look at Walmart's outsize effect there. You can see Walmart down 6.5%. That's a pretty big drop for Walmart. It doesn't have that big of volatility. JPMorgan also coming off a lot of record highs. That's down 4.5%. Goldman Sachs down almost 4%. So financials up there this year, but giving back some gains today. And I just wanted to check out the retail sector here, if we can find that. Doesn't look like I'm going to find that, but I wanted to go back to China. Let's do China to end the day. Alibaba up 8%, JD.com up 5%. China has been on a tear. You don't necessarily see a field of green here, but Baba, the biggest, definitely leading things higher. Guys?
Jared, thanks so much. A tough day on Wall Street. The S&P 500 pulling back from a record as Walmart's guidance raised concerns for investors. And earnings haven't been the only driver of some recent volatility. Another one is tariffs. Our next guest says that volatility is creating opportunities for investors. Joining us now is Jeff McLean, Solidarity Capital CEO. And Jeff, tariffs has been the talk on Wall Street. You call it a distraction, but again, leading to some opportunities. So where are those pockets of volatility in your view?
Yeah, great question. I think with tariffs, it's admittedly the number one question we're getting from investors and clients of what that means. What it does, though, is create some great opportunities. Look at Walmart today. Walmart plummets based on some weakness in their forward projections, although the CFO came out later today to say, whoa, you're taking this way too far. We do this every year. Relax. But a lot of the worry is around tariffs related to Walmart. Related to the weakening consumer, related to inflation, related to tariffs. And when you have an opportunity like a Walmart that's done incredibly well to start this year, as your colleague just talked about, they had a great start to the year. They dropped today. I would say the drop today is a little overreaction. That's a perfect example of a great opportunity to seize based on volatility. From a great long-term company that continues to make a ton of money, will continue to do really well, will have some impact with tariffs, but not a lot. They talked about that a little bit on their call, that they won't be hugely impacted, but of course it has an impact on everyone if it's a big number at the end of the day with a tariff. But overall, that's a perfect example of where tariffs, you can take advantage of the volatility, which I think is, again, short term. There's a big difference between the negotiating position that the president's trying to take with these big numbers against Mexico, against Canada, The only one actually put in place is the one against China and a bunch of threats on other ones. But again, it's a negotiation. And I think long term, the impact of it will be very muted.
So, Jeff, are you sort of using this playbook throughout the market where you're sort of looking for these kinds of dislocations where perhaps companies have been punished in a way that you don't think is appropriate?
100%. And so, I mean, there's just an opportunity when that happens. If you have a really good company, right? We're from an investment perspective, we're all about buying really good companies long term. But as some of the great investors always talk about, Howard Marks, one of them, the predominant factor in your return is what did you buy that at? And so if you're watching a few of these companies, you're keeping them on your target list, you're trying to find that good entry point from a valuation perspective, and you get a mispriced drop because of the news of the day, tariffs, or what did the president tweet this morning, or whatever network he's on, I can't remember what that's called, but whatever it is, he puts out some proclamation and boom, you have a drop in a company you love. It's a great opportunity. I mean, you look across the market today of some of the companies that have dropped a lot. You mentioned Walmart on there earlier. JPMorgan was on there as a big dropper today. Goldman Sachs. If you like those companies long term, and now you can buy them in 4 to 6 to 8% off of where they were just 24 hours ago, that's a fantastic opportunity to play the volatility.
Let's stick with that opportunity. Nike, you like it, hasn't done that well. Where do you see the value there?
Yeah, Nike's had a rough road. Admittedly, a lot of that was with the prior CEO. Big news on Nike these past 2-3 weeks, right? They finally did their first Super Bowl ads in quite some time that had a lot of big traction. You had a Nike athlete, Jalen Hurts, wearing Jordan brand shoes during the Super Bowl. You have Bill Ackman upping his stake by 15% over the past week. And you have the deal with the Kardashians, right? The Kardashian brand. That's a big opportunity. And as they talked about, they've kind of missed the road a little bit with this Lululemon play and the success Lulu's had. If they can focus more on the women's segment, continue to grow it. We are super bullish, I think, along with kind of Bill Ackman and the other activist investors into Nike of where this could go. And with Elliott Hill at the helm, right, it's an incredible story. This is a guy, again, who started as an intern at Nike 37 years ago. How amazing is this if he can actually turn it around? They have momentum. You have not seen that play in the stock yet, openly. But if you're looking at Nike from a long-term play, think 2, 3, 4 years from now, I am bullish on where Nike can go, that they can get back to where they were and they can right the ship.
Jeff, we'll be watching it to see how that plays out. Yeah. Good to see you. Thank you.
Yeah, thank you.
Coming up, we'll get you the latest earnings results from Rivian and Block as those numbers are crossing the wire. Stay tuned. More market domination overtime coming up.
Recent economic volatility coupled with President Trump's tariff threats has some retail investors looking to shake up their portfolios or rotate out of some of those big names altogether. Joining us now to give us some more insight on how the retail trader is thinking is Steve Quirk, Robinhood Chief Brokerage Officer. So Steve, we're now 1 month into Trump's presidency. How have you seen retail investors change up their positions based on policy and what we've been hearing out of DC?
Oh, first of all, thanks for having me. Yeah, we've seen our customers immediately following the election try and take advantage of what they saw as opportunities to add to portfolio or remove some of the stocks in their portfolios based on their interpretation of what it would mean. So, obviously we've seen a pretty big bump in some names like Tesla and NVIDIA and others, and in the cryptocurrency space as well. And as a result, our customers have sort of taken that ride and they're rotating. We tend to see a behavior where when they've had appreciable gains, they will take some of those gains off and then look for other names that maybe haven't participated in the rally to add to their portfolio. I think the one other element that's been most interesting is not only what they're doing, but when they're doing it. So a lot of, we give customers the ability to trade over 900 securities around the clock, 5 days a week. And a lot of this market moving news, like the tariff news, happens when the primary market is closed. So we've seen a big growth in people trading when market moving news is happening.
That's really interesting, Steve. It's Julie here. It's good to see you. So I have a couple of follow-up questions for you. On that
nice to see you.
Good to see you. On that last point, the regular markets, right? It seems like professionals are sort of shrugging off a lot of the tariff noise. It seems like they see it as noise. But what you're saying implies that there is more of a reactivity among retail traders. Is that fair to say?
It's fair. I wouldn't say there's more reactivity. What I would say is sometimes when the news first hits, there tends to be a bit of an overreaction. And like in the case of tariffs, that overreaction was an opportunity for people to add names that they thought would be attractive at levels that they didn't think they'd be able to get them. And as you pointed out, as soon as the day session came around, some of those names were back to the levels that they previously were at. So I think that tends to happen with news in general. When it first hits, everybody has to digest it. So there tends to be a little bit more anxiety with the moves that happen. And if it's an opportune time, if you're looking to add to a portfolio.
And Steve, I guess the other question I would ask about the rotation you were asking about, and again, the sort of differences you might be seeing in between retail traders and professional investors. We have seen the much discussed broadening start to actually happen in the market, right? Where we have seen, yes, big cap tech is doing okay, but kind of underperforming writ large. But then financials have been gaining some steam. Walmart until today gaining some steam. Are you seeing those kinds of similar trades amongst your users?
We are, there's still a core group of names that constitute many of the portfolios of our retail customers, but they also are adding to that and hoping and looking for that to broaden out. And it's widely anticipated that if we want to see this market continue to rally, we're going to have to see some growth in the number of names that are carrying it, if you will.
And Steve, we've seen some short selling action to kick off the year. What are you looking at when you think about some of those more meme stock-like names?
When we look at what our customers do, they typically have their core portfolio, and then they'll look at names that tend to have a little bit more volatility or become either depressed or might run up, and they'll try and take advantage of the shorter term moves. But the core of what they do is sort of that portfolio, and then this is what I'd call the things that they do around the edges. And those tend to have more exaggerated moves or be a little more volatile.
Steve, good to see you. Thanks a lot for joining us.
Thank you. Thanks for having me.
Let's get to some earnings now here. We've got numbers from Block just crossing the wire. The share's down about 7% here because we do see sort of missed estimates on a number of fronts, or missed numbers on a number of fronts. Fourth quarter earnings per share, 71 cents. That's versus the 89 cents that analysts had been anticipating. Revenue for the fourth quarter also coming in at $6.03 billion. That is a miss versus estimates. And then EBITDA, by that measure, it is beating estimates, but it looks like investors may be paying more attention to the EPS and to the revenue numbers. EBITDA for the fourth quarter on an adjusted basis is $757 million. And the company is also giving some forecasts for the first quarter, including first quarter adjusted operating income. Block is predicting that will be $430 million, $463.5 million is the estimate from analysts. Now, Block, by the way, which used to be Square, you may notice, if you hadn't seen this before, that the company changed its ticker symbol, right? Changed it to XYZ. The company name remains Block, at least for now, Allie. Just a little sub note.
Yeah, no, and it's, like you were just saying, we're seeing a lot of misses across the board here. Losses seem to be escalating. We're down now about 7%. Coming into the report, analysts had expected Bitcoin revenue to actually be a tailwind for the Cash App services, but Bitcoin revenue missing estimates there. Strength in the Cash App card, along with Buy Now, Pay Later, that was expected to boost gross profit. A miss there as well. Investment spending that seemed to have also weighed on the forecast for that Q1 profit guidance. Now on the call, investors will want to hear more about the Cash App's direct deposit accounts, maybe some operating efficiency there, and why we saw such misses across the board here. Again, shares off about 7%.
Now, Jack Dorsey in his letter to shareholders really emphasized that the last year he has spent overhauling the company, improving things, and that this year they can move ahead. He says in the note to investors here, we overhauled the technology that underpins Square, shifting from a payment solution to a commerce platform. And he enumerates some other things that they worked on improving. And so now pushing ahead, and he's really emphasizing access and openness in terms of this being a platform for everyone to use. Now, we'll see if investors end up coming around to that, right, once they get past these numbers.
Yeah, so maybe one of those quarters that you just have to deal with some of that pain to get to some better news later on, but we'll see. Another earnings report that we're taking a close look at is Rivian. Shares of the company, they're up right now, about 3.5% there after the car maker reported mixed fourth quarter results, but it did come through on posting a gross profit for the quarter, $170 million in Q4. That was primarily driven by improvements in variable costs, revenue per delivered unit, and fixed costs. They also had an expected full year 2024 EBITDA loss that was smaller than expected, and they also see a smaller loss in 2025 compared to a year ago. Now, Q4 was an interesting one for Rivian, especially when we think about the policy of it all. They had back in earlier this year, they announced an expansionship of his partnership with Volkswagen. November of last year is when they made that announcement. And they also recently revealed that they won a conditional commitment from the Department of Energy for a $6.6 billion loan. Now, with everything going on in D.C., all those DOGE efforts, that loan could be under some scrutiny there. So Rivian, one of those companies where the policy story is just so murky that it's encouraging to receive a solid report like this.
And they acknowledge that in the release here. RJ Scaringe, the head of the company, saying in the statement, or they said in the statement, external factors could impact Rivian's 2025 expectations, including changes to government policies and regulations and a challenging demand environment. And they note Rivian's guidance represents management's current view on potential adjustments to incentives, regulations, and tariff structures. So modeling it in as best they can here, the company says that adjusted EBITDA this year will be a loss of $1.7 million to a loss of $1.9 million. They said this year they plan to deliver 46,000 to 51,000 cars. That's a little bit short of estimates. I gotta say, anecdotally, I feel like I've been seeing more Rivians around lately.
Have you? I've been seeing a lot of Tesla Cybertrucks recently.
Well, those are hard to miss.
Maybe that's why, Julie.
But yeah, there's definitely more of these things.
Yeah, in
driving around.
early January, the company produced nearly 50,000 vehicles and delivered nearly 52,000 in 2024. So we're seeing a little bit of that year-over-year deceleration. But I mean, we're at the mid-end of those estimates there, at least for January.
Well, from EVs to robots, shall we?
Love it.
Companies are getting in on humanoid robots, specifically big tech players like Tesla, Amazon, Google. They each are funding or developing humanoid robotic systems, while Meta and Apple reportedly also getting in on the action, according to Bloomberg. But the reality of it all will take some time. Here with more, Yahoo Finance's resident robot reporter. He's not a robot himself. He reports on robots. Dan Howley. Hey, Dan.
Yeah, Julie, it's interesting. This is something that's seemingly blowing up now within big tech, although it's been obviously going on for quite some time. We've seen things like the Boston Dynamics robots over the years, but now we're seeing more and more big tech interest in this space, whether it's through, as you said, funding or working on the systems themselves, like companies like Amazon and Tesla do. Ford is also in there. Some automotive makers really a part of this because the technologies are similar in that you'll see some companies use different kind of sensing capabilities in cars and then go ahead and put them into robots as well. It makes sense when they're trying to navigate the world. But part of the problems that we've been seeing over the years for these robots is really the bipedal situation. Walking, it turns out, is incredibly difficult. It took us, I don't know how many thousands of years in evolution to go from all fours to standing upright. It's going to take a while for that to work with robots. And while that is improving and we are seeing more bipedal robots, there's also another issue. And it's our hands are incredibly intricate. And so getting robots to work to have similar capabilities as our hands, not just being able to move them, but to be able to grab, say, an egg or a glass and not crush it entirely, but grab it gently, is also something that they're working on. There's also the matter of, well, I look at a cup and I recognize, oh, it's a cup, I can drink out of that, or I can pour water from it, is just something we take for granted. But you have to teach robots how to do things like that, how to recognize things, and then how those objects can be applied in the real world. It's a very interesting series of issues. Now, there's a few ways that companies are going about teaching robots, quote unquote, teaching robots, how to do these things. There's by actually showing them or mirroring human movement via specialized equipment that a person wears and then is translated for a robot, or through simulations. Now, NVIDIA at CES 2025 had showed off its Cosmos world models, and that's really where they kind of develop real-world situations digitally and map that so that a robot can understand how things would happen in the real world. It's less expensive because it doesn't mean having to put a robot at risk. The issue is they can't simulate everything perfectly. One professor that I spoke to said things like cloth are difficult to really figure out for simulations. Things that are soft or easily moved can be tough. So it's not as though one is better than the other. It's got to be a mixed approach. Another expert that I talked to had said, and just outside of that, there's the practical issues that we're seeing occur, whether that's battery life. Your phone might last for a while. It's not going to last as long for a robot. And then heating. Believe it or not, the motors and actuators that move robots heat up over time, and they'll have to shut down if they can't cool off fast enough. So it's interesting. We're seeing this push right now, but there's still going to be a ways to go. And though it sounds like I'm poo-pooing it, I spoke to one expert who basically said it's going to happen.
Well, we'll see when. It sounds like it's going to take a while, Dan. Thank you. Time now for What to Watch Friday, February 21st. Starting off on the housing front, we'll be getting monthly existing home sales data for January in the morning. Economists forecast sales there will drop compared to December to an annual pace of 4.13 million. The new data providing a clearer picture into a housing market dealing with high mortgage rates and elevated home prices.
And checking in on the Fed, some more Fed commentary coming throughout the day with Fed Vice Chairman Philip Jefferson and San Francisco Fed President Mary Daly. This coming after comments yesterday from Atlanta Fed President Raphael Bostic. Bostic telling Yahoo Finance that he's not taking anything off the table when it comes to interest rate cuts at the next Fed meeting.
Taking a look at the consumer, the final reading on consumer sentiment for February coming out in the morning. Economists not expecting any change from the prior reading of 67.8, giving us more insight into the state of the consumer.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. A rough day for markets after Walmart earnings signaled there could be trouble ahead thanks to looming tariffs. We'll break down the rest of today's market trends. Then Commerce Secretary Howard Lutnick wants cruise lines to pay taxes. Yet President Trump has been vocal about wanting to lower taxes for individuals and companies. We'll talk about the possible shifts in the tax landscape. Plus, tonight, recent hostilities between the U.S. and Canada spill over onto the ice. We'll tell you why the four nations face-off title game is such a big deal for both sides and why viewership numbers in Canada could be staggering. Well, the S&P 500 retreats from records as the Dow slides 450 points following Walmart's cautious outlook. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways, and let's start with Walmart.
Yes, Julie, let's start with Walmart because that was one of the key laggards in the Dow driving that downside action. So let's take a look at Walmart stock on the day. So Walmart, the key driver here seemed to be guidance for the full year of 2025 or fiscal year 2026 for Walmart, but this year coming in softer than expected. So stock actually had its worst day. I'm going to put a year to date on here so we can see the drop a little better. Stock had its worst day since November 2023. You can see though, had been performing pretty well, which is going to be a trend we're going to talk about here with a lot of the stocks that fell today. But I think, Julie, what this really spoke to for me, growing anxieties around tariffs, growing anxieties around what it could mean for the consumer, what it means for not just companies, right, but what it also means for the consumer outlook for 2025. And you saw that play out a little bit across the retail sector. But I don't usually like putting too much stock into what we hear about one company being perhaps a little bit conservative at a time it might make sense to be conservative. And spinning that into an overall, is the consumer slowing, oh no, kind of story. But it gives it a little bit of fodder anyway.
Right, well, and even the company itself, an analyst pointing out that Walmart tends to be conservative at the beginning of the year. I mean, that said, this is a reflection of a couple things. One, Walmart has done very well this year, as you pointed out. And two, even though we have, analysts and strategists come on the show pretty much every day and say, tariffs are not the worst case scenario. They say it's probably not happening and you don't see it priced into the overall market. Something like this illustrates that there is still a little bit of vulnerability and concern around the issue.
Yes, absolutely. And I think overall it just kind of gave us a little bit of a catalyst for the day, right? So Walmart earnings were out before the day started. I'll flip over so we can take a clear look at takeaway number 2.
Yes.
It is 2025 winners taking a breather. So as we mentioned,
so Walmart was one example.
Walmart was one example. And then when you look inside the Dow itself, some other examples were just financial stocks. I'm going to equal weight this out for us. Look at your other worst performers. JPMorgan. Let's take a look at JPMorgan year to date. Guess what? Stock had been doing pretty well before today. Similar story with Goldman Sachs. And then when you take a look inside the Nasdaq 100, some of our bigger movers, of course, some individual headlines moving these stocks like a Palantir, but still, it just felt like momentum that we had been talking about for the past week or so with a lot of these big individual movers. CrowdStrike down today, Palo Alto down today. A lot of these stocks that had been doing well, just taking a breather after a pretty solid stretch.
Yeah, which happens sometimes in a market, especially a market without macro catalysts.
Exactly, and I think one thing that was interesting, Citi highlighted this today, Scott Kroner highlighted, overall he feels like the market has just priced in a lot of good news at this point, and he said, overall for the year, still feeling positive about the 6,500 target on the S&P. Still feels like we could get good returns, but negative headlines in the next month or so, you might see a little bit more of a jumpy market. He feels like a lot of the good news is priced in, and if we hear any sort of negative headlines, maybe we get a little bit of chop over there.
Well, there's a bunch of tariff deadlines coming up, so we'll see how that is going to play out. Thanks, Josh. Well, Commerce Secretary Howard Lutnick making headlines, suggesting the Trump administration would have cruise lines paying U.S. taxes. And on the other hand, President Trump has been vocal about wanting to lower taxes for individuals and especially for companies as well. Here to sort through the potential shifts in the tax landscape, we've got American Enterprise Institute Senior Fellow Kyle Pomerleau. Kyle, there's a lot to sift through here, obviously. Tax is a complicated issue. But I wanted to start with the idea that most corporations are trying as hard as they can to pay the least tax that they can through a number of different methods, right? And so I wonder what you think of this particular comment or gesture by Lutnick to try to sort of change that situation when it comes to cruise lines.
It's not clear exactly what policy he is thinking about enacting, but rhetoric aside, and also campaign promises aside, I think where you want to focus with respect to corporate tax policy and what might be happening over the next year is Congress. And Congress right now they're currently debating a bill that is going to extend the individual provisions of the Trump tax cuts. And those provisions are going to be very expensive. And as a result, they're not going to have a lot of fiscal space to do additional corporate tax cuts. So the campaign promises that Trump put forward, the lower 15% corporate tax rate, that's potentially unlikely. They may do some small corporate tax cuts for manufacturing, and they might also be looking in the certain industries to raise revenue in order to offset the cost of these individual provisions. Cruise ships, Maybe, but I haven't seen it specifically discussed except in last night's comments.
Right, just sort of that off the cuff, perhaps, comment, right? So it sounds like then you don't expect a more wholesale look at where companies are domiciled, whether they could be paying more in U.S. taxes, for example, even with a cut. It doesn't sound like that is something that is sort of systematically being looked at.
Yeah, tax reform, even when the politics are favorable, is still very difficult. It takes years to plan. Lots of decisions need to be made about how to reform the taxation of corporations. I mean, when they reformed taxes for multinational corporations in 2017, that was after nearly a decade of debate amongst Republicans and Democrats before that was passed. This time around, not the same debate happening. It's really more about extending the individual provisions and less about reforming any particular aspects of corporate tax policy. So I don't see any major changes to the structure of corporate taxes happening.
So even if you just do the extension of the individual tax cuts, which is, as you said, is being discussed, there's also being discussed that you need something perhaps on the other side of the ledger, right? You need to bring in revenue, you need to offset it. And there's a lot of questions about how that could happen, especially if, as many of the market participants we speak to assume, that the tariff discussions are mostly a negotiating tactic. So if you're not getting revenue that way, and the tax cuts extension is going to cost you, where do you get that revenue from?
Yeah, and even if the tariffs do happen, there are budgetary rules that limit lawmakers' ability to use that as an offset. So they're going to have to look at the tax code in order to offset the cost, the potential $4.8 trillion cost of extending the individual provisions. Now, there are some business tax provisions that they may be considering. One provision would limit the ability of corporations to deduct their state and local taxes paid against their federal taxable income. Another provision that might be looked at is raising the new excise tax on stock buybacks that was introduced by under the Biden administration. Those are ideas that are floating around now. Those are not necessarily large revenue raisers, so lawmakers are still going to be producing a lot of red ink. They've also looked at reductions in spending, but so far what I'm seeing are not very significant or aggressive reductions in spending that could get them to a bill that doesn't increase the deficit. So ultimately, we're going to be looking at more debt and more borrowing, not less of it.
Well, and then, Kyle, before we even start talking about tax changes, there's the work of DOGE, right? And the Wall Street Journal now reporting that we're talking about 6,000 people begun to be laid off from the Internal Revenue Service. What is that going to mean for tax collection in the short term?
Yeah, generally the DOGE project is, I think, going to be not very effective in reducing federal spending. I think they're going to be reducing spending, but we're going to be counting that in the billions of dollars, not trillions of dollars. So you really can't count on that. But the specific changes to the IRS, they're going to be saving a little bit of money on employee salaries, but on net, that's actually going to cost the federal government, because if they're laying off workers that are in charge of auditing companies or auditing taxpayers that might not be paying taxes or might be underreporting their income, we're not going to get that revenue. And most analyses find that sort of spending on auditors, actually raises revenue net of any spending on these workers' wages.
Well, we'll see if they end up trying to hire some of those people back like they've been doing in other areas of the government then when they realize that, maybe. Kyle, thank you very much. Appreciate your time.
Thank you.
Stick around. More Asking for a Trend on the other side. Thanks to President Trump's tariff threats, the United States and Canada have not been on the best terms lately. Tonight, that hostility will extend to the ice when the U.S. hosts Canada in the inaugural Four Nations face-off title game. The U.S. won the previous match up on Saturday 3-1. Joining us now, Joe Pompliano, Yahoo Finance Sports Report host. Joe, why is this such a huge deal that this is happening, and what kind of vibes are we going to see out there on the ice?
Yeah, thanks for having me, Julie. I think it's going to be a fantastic game. Part of the alert of this tournament here is that, one, the NHL is usually getting in place at their All-Star game, which is usually not a great game because if it's like the NBA All-Star game or the NFL Pro Bowl, the players don't usually take it that seriously. So this is a heightened level of competition. But I think it's that way because not only are you playing for your country, but NHL players haven't participated in international competitions at the Olympics over the last 2 cycles. So that's nearly a decade at this point where they all haven't been representing their country on the biggest stage. So if you look at the last matchup between Canada and the U.S. on Saturday night this past weekend, we had over 10.1 million viewers in North America alone, a little bit more in Canada than the U.S. But this game, I think, should rival that number, if not higher.
Well, and this is the first year that the NHL has tried this. So judging by some of those numbers you were just talking about, judging by the response, safe to say it's gone above and beyond the league's expectations?
Yeah, the commissioner, Gary Bettman, was doing his TV media tour today, kind of taking congratulations from everyone because the numbers have blown everyone out of the water. I mean, if you think about the NBA specifically with their All-Star game, this game was taking place the same night as the skills competition or the dunk contest for the NBA, and it completely overshadowed it on social media. So this was a huge win for the NHL. And look, that game was on ABC, whereas this game's on ESPN. So there's a little bit of difference between broadcast television and cable television when it comes to reach. But if we put up anywhere close to a 10 to 12 to 14 million number again, that's going to be a huge win for the NHL, but also ESPN.
I'm curious, do you feel like that the politics aspect of it has sort of increased the visibility of the game, or do you think people were pretty pumped about it already and we're going to tune in?
No, I think so. I mean, part of it was Canada booed the U.S. national anthem when it came on Saturday night. Would they have done that without some of the stuff that's going on politically? Probably not, is my guess, but we'll never know. I did see a funny joke online afterwards, though. They said the final score was 3-1 in the game, but it was actually 3.25 to 1 once you had the tariff, which I thought was pretty good. Oh,
dear. All right. Let's switch gears here and talk about football a little bit and the business of football. According to a new report, the San Francisco 49ers, they're considering selling a 10% minority stake in the team at a valuation for the overall team of $9 billion. So the Miami Dolphins, the Buffalo Bills, they've already struck deals with investment firms. Why are all of these deals happening? Why are they so attractive for both sides?
Yeah, so this is a new phenomenon in the NFL. I mean, it's happened in other sports leagues over the last few years. The NFL was actually the last major U.S. professional sports league to approve private equity firms to take minority stakes. But it's been a long time coming. These ownership groups have been looking for liquidity on smaller stakes for a few reasons, but primarily because it enables them to maintain control of the team while taking some money off the table. Now, typically the way these deals would work from a minority standpoint is you would have to go find an individual who's willing to pay $500 million or $1 billion for 10% of the team. And they would get a 20 to 30% discount usually because it doesn't come with any control. All you really get is season tickets. You don't get to make any decisions. Whereas a private equity firm is a little bit less price sensitive. They don't care about that stuff. So they're willing to pay the full share of what that is worth. Call it, $500 million, $1 billion, potentially more, depending on how much those private equity firms are buying. So this is a great situation for not only the private equity firms and the endowments that are able to buy into the teams. It's a good place for them to park cash that historically has outperformed the stock market, but it's also great for the teams because they're able to take some money off the table, and the league because it's going to keep valuations going higher.
Win, win, win. All right, Joe, thanks. Good to see you.
Thank you.
And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report. It drops every Thursday at 5 p.m. Eastern. Here's a look at the newest episode.
In order for expansion to work, you need 3 things. First, the market. And we just talked about that. San Diego, great market, always has been for soccer, no doubt about that. Next is the stadium. You need to have a tangible plan, either a real building to go into or a believable plan for MLS to say you're going to have your own stadium within a really short period of time. And then the third thing is the money. You need to have the capital. You need to have the principal investors. So in this case, we had the market for sure. Then we had the stadium because San Diego State University has redeveloped where Jack Murphy Stadium, Qualcomm Stadium used to be, where the Chargers used to play. They won this big battle, this big bid to redo that land. And they built a 32,500 seat venue that's perfect for soccer. So we had the stadium, we had the market. It just came down to finding the investors.
For our chart of the day, we're taking a deeper look at inflation expectations over the next 5 years. Yahoo Finance's Alexander Canal joins me now with a closer look. Allie, what do you got?
Hey, Julie. Yeah, so this is the 5-year break-even inflation rate, which is a measure of expected inflation derived from Treasury spreads. So essentially, it is the difference between the yield of a nominal bond and an inflation-linked bond of that same maturity. And it's often an indicator when it comes to where inflation could be heading over the long term. And we're seeing the rate at just around 2.6%. That means the bond market expects inflation to average around that level over the next 5 years. But what's notable here is that 2.6, that's the highest level, and we have not seen that since back into fall of 2022. So that's something to keep in mind as we see expectations steadily on the rise. And to that point, on Wednesday, the Fed released its meeting minutes from January, which showed officials see upside risks to inflation. They cited the possible side effects of potential changes in trade and immigration policy. And then earlier today, we heard from the chief economist at ADP, Neela Richardson, who said the labor market could also be a source of inflationary pressures. Take a look at what she had to say.
What economists are always the most worried about when it comes to the labor market and inflation is that wages would spiral out of control and trigger inflation. We're not seeing that yet. We haven't seen it, actually. Wages have fallen a lot in terms of growth from the peak pandemic growth rates that they had coming out of it, but they're still elevated. And so in my view, it's why inflation hasn't gone back to more comfortable levels quite yet.
So all things are good right now, but the labor market is always a really important area of the economy to keep an eye on, since any weakening there or spiral to the upside in wages, like Neela alluded to, that could be a big problem for the Federal Reserve. Julie?
Indeed, it could, and we know they're watching it closely. Thanks, Allie. Let's take a look at what's trending after hours. Shares of Booking Holdings rising as fourth quarter revenue beats estimates. Gross bookings for the quarter also topped Wall Street's expectations. Booking Holdings highlighting a 10% increase to its quarterly cash dividend per share as well. And check out shares of Mercado Libre jumping after hours on fourth quarter results. The company is the most valuable in Latin America, and it posted record net income of $639 million, blowing past analysts' expectations. Revenue also beat Wall Street estimates. And I'll be speaking with Mercado Libre CFO Martin de los Santos. That's tomorrow at 4:15 p.m. Eastern. Finally, shares of Celsius Holdings jumping following its latest earnings report that saw international revenue grow 39% year over year. Total revenue in the fourth quarter for the beverage company came in well above analyst expectations. And it also announced that it's entered into a definitive agreement to acquire competitor Alani Nutrition for $1.8 billion in cash, in a cash stock deal. Those shares up by 30%. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.